The keys for stocks in this beginning of the new decade are going to be what?
I actually think it's where rates go. We've had this extraordinary presence of negative interest rates around the world, and there are signs that maybe we are at the end of this. And if Europe follows what the Swedes did and decide to get out of negative interest rates, what does that mean for global interest rates? Because we know asset prices, generally speaking, have been medicated on a very low rate type of environment. So I think that's what I am most focused on over the next couple of years, because negative interest rates is just unsustainable, I think.
Yeah, and we've certainly seen the effect it has had on financial systems in Europe and other places of the world. I think the key question there, though, is if you actually start to see that happen, is it seen as a tightening in the monetary cycle?
Well, it's going to be. But that's the thing is, if global growth inflects higher in 2020 because of the Fed engineering a soft landing, because of a trade deal, well, rates just aren't going to be where they are. They're going to trend higher. There's going to be pressure on the ECB to follow what the Swedes did. And if the ECB tries to get out of negative interest rates, what does the Swiss do? And if your interest rates rise over there, they're going to rise here, even if the Fed does nothing. So asset prices are obviously rich. Markets trading at 20 times earnings. Now, that can be sustainable if rates stay low. If rates go up, we have to wonder what the right multiple then will be.
Well, it depends on, Mark, what earnings are going to be. That's the big question. How do you think that's going to shake out in the new year?
I think corporate earnings will be flat. I think sales growth should be mid-single digits, consistent with an okay economy, a 2% real GDP growth economy. But I think profit margins, which have been under pressure now for the past 3-4 years, at least economy-wide, will continue to weaken. Labor costs will continue to rise. Wage growth will improve, and productivity growth will still be weak. So I think margins will be under pressure. That'll offset the mid-single-digit sales growth, and we get flat corporate earnings growth. So, I'm sympathetic to Peter's perspective. I think asset prices, stock prices are vulnerable in this kind of environment.